Hey guys. Welcome to Desk Corner 1. It's DECO again. One of the hottest keywords in the investment universe these days is gold. While gold and silver had a robust rally over the past few months, they just had a bizarre week when their prices took a roller coaster ride. Silver slid more than 15% on Tuesday after the Russia vaccine news but rebound 10% on Thursday. In this video, we are going to discuss one of the most frequently talked about terms in gold trading, the gold-silver ratio. I am also going to share a secret way to use the ratio which I haven't seen anyone talked about it yet. Let's begin. While many people would agree gold is unique as an asset, it is hard to value gold. Unlike most other asset classes such as stocks, bonds or properties, gold in itself can generate no income or cash flow. As a metal, it doesn't resemble other metallic commodities, either. Industrial or scientific use makes up only 10% of gold's demand. Most of demand for gold comes from jewelry and investment. Therefore, there exists no model to evaluate gold in absolute dollar value. Instead, we would normally employ a relative valuation approach. And the most common two measures are oil and silver. If you are not completely new to gold trading, you would probably have heard of the gold-silver ratio. This ratio represents the number of ounces of silver required to purchase 1 ounce of gold. This ratio allows the trader to determine the optimal time to purchase one metal over the other. When this ratio is high, it takes more ounces of silver to exchange for 1 ounce of gold, implying gold is expensive and silver is cheap. When the ratio is low, it would mean the other way around. While silver is the closest relative to gold in the investment universe, both metals have long history of being used as money at the past. Hence, it seems all very logical about using this ratio. But, looking into historical data of gold-silver ratio, what is a reasonable way to determine highs and lows of this ratio? Or, here we have the past 100 years data. Can you tell me now, which one, gold or silver, is relatively more expensive as of today? One conventional way that most people would use is to compare with the historical average. If we look at the past 100 years, the average is around 60. If we look at the ratio on 12 August, it was at around 75. Does it mean that gold is 20% overvalued relative to silver? What if I tell you, based on the same set of historical data, I think it is the other way around, that silver is relatively more expensive? And this might give us some clue on the much worse slump in silver price than gold on Tuesday. So, how does DECO come up with such an insane conclusion? Let's take a look at this chart. It shows the prices of silver and gold from January 1971 to July 2019. I do not pick this year randomly, for it looks good to be exactly 50 years from now. I choose it for a very good reason. 1971 is the year when the US closed its gold window, bringing the Bretton Woods system to the brink of collapse. If you don't know what the Bretton Woods system is, it was the international gold standard monetary management system. I would talk about it in details in upcoming videos given its importance to the modern economy. Simply put, after the Bretton Woods system collapsed, gold standard was dead. We entered the age of fiat money. Governments in the world no longer back their currencies by any physical goods. Ever since then, the prices of gold and silver have become floating relative to different currencies. I chose the year of 1971 because it makes no sense to mess with data when it was still in the gold standard period, during which gold price was under the control by governments. We are now in the post-Bretton Woods world. To make it easier for comparison, I have rebased gold and silver prices at the end of January 1971 to 100. Again, in finding the fair gold to silver ratio, if we do it by calculating the historical average, how long is the period of data shall we use? Is it 5 years, which looks pretty high given we are in a rally lasting for years? Or is it 10 years, which seems lower, but does a lower ratio means more reasonable? Or, can we simply use the data for the past 50 years, which is much closer to the 100 years average mentioned earlier? But something doesn't seem right, does it? Yes, you have already noticed. In the post-Bretton Woods world, even though gold and silver share similar cycle and have a strong correlation in the direction of price movement, gold has significantly outperformed silver. If this trend continues, it would be completely nonsense to get a gold-silver ratio based on simple average of historical data. So what do we do? First of all, I calculated the cumulative annual growth rate of the past 50 years for gold price, which is around 8.3%. And that of silver price, which is around 5.8%. The net difference would be around 2.5%, meaning on average gold price rises faster than silver by 2.5% per year. Next, I used the initial gold-silver ratio at January 1971, which was 23.77, and compound it at 2.5% per annum to find the fair gold-silver ratio. And here is the result. As you can see, over time, the theoretical gold-silver ratio fits much better to the long-term trend of gold-silver ratio in the post-Bretton Woods world than the simple average. So, let's get back to the question. Is silver or gold more expensive as at 12th of August when the gold-silver ratio is at 75? If we use the historical average, gold is still more expensive. But if we use my methodology, the fair gold-silver ratio as at August 20th should be around 81, meaning silver is actually more expensive. This also explains why silver slumped much worse than gold on Tuesday when the gold-silver ratio was below 70. Now I have shared with you a little secret on gold-silver ratio. So, in practice, how do we incorporate it into our trading or investment? As we can see that in the long run gold and silver prices had a strong correlation, and the gold-silver ratio swings around our projection, we can use the mean reversion strategy. Which means we buy the cheaper asset, and short the more expensive asset, with a view that the ratio would reverse back to its fair value. This can be easily done through ETFs backed by physical gold and silver, GLD and SLV. Or, if you do not know how to short sell, there are inverse ETF products available. If you want to leverage the return, there are also leveraged ETFs on both long and short directions. Nevertheless, all the inverse or leveraged products are not backed by physical gold and silver. Instead, they are what we called synthetic products constructed primarily by future contracts. In addition, the daily rebalancing setup of these kinds of products would harm your return more the longer you hold them. One important point to note though. Just like all kind of investment we do, we should always keep a sufficient margin of safety. That says, even if the ratio shows that one metal is more expensive over the other, it can stay above its fair value for months, or years. Worse still, it can get more expensive. Then, we would be losing money. Besides, because both gold and silver can hardly be valued by financial models, when the difference in actual and theoretical ratio is small, market tends not to react quickly to it. Here I would suggest you always keep at least 15 to 20% of margin of safety for your trade. For example, if the fair gold-silver ratio is 80, and we require a 20% margin of safety, we would short gold and long silver when the ratio rises above 96, and we would long gold and short silver when the ratio is below 64. Later on, when the ratio restored to around its fair value, we might lose money on the expensive leg, but the gain in the cheap leg would be able to cover all the losses on the other leg and we are still able to pocket that 20% difference. When the gold-silver ratio reached its historical high of over 125 in March, markets started to react. Not by a drop in gold price, rather by a rocket surge in silver price. A perfect example of mean reversion by relative valuation. The more expensive asset's price does not necessarily drop in the end, but by late July, the gold-silver ratio has restored back to our projected average. If you are a long-term investor who doesn't want to short anything, and always keep a fraction of your portfolio in precious metal to diversify risks from equities and bonds, you can also make use of the gold-silver ratio too. How? By asset allocation. There is an important point here, because in the long term, gold price tends to outperform silver. We do not need to switch around silver and gold all the time. Instead, we keep the portion for precious metal and gold, and switch it only when silver is really cheap relative to gold. Unlike the mean reversion strategy, we do not have any short leg to protect on the downside. Therefore, I suggest a higher margin of safety, say 30–40% to be used, if you just do this in a long-only portfolio. In 1997, the legendary investor Warren Buffett bought over 130 million ounces of silver, making him one of the largest holders of silver in the world at that time. The silver-to-gold ratio was at 75, significantly higher than our projection. In 2006, he sold his silver holdings to be the founding inventory of the silver ETF, SLV, mentioned earlier. Although he himself also agreed that was too early, he still made a better return than if he held gold during this period. On 28 July, analysts of Goldman Sachs have raised their 12-month target price of gold to $2,300, and that of silver to $30. The implied gold-silver ratio by the forecasts is 76. What do you think about investments in gold and silver as of today? Feel free to leave your comments below and let's discuss more. If you love this video, smash the like button, and subscribe to my channel. DECO may not update his channel as frequent as a full-time, but whether or not you want to choose your preferred content, instead of being hijacked by AI, is all up to you. I am DECO. I tell story of numbers. Thank you and see you next time.